Is the stock market ready for a potential collapse? Well, I think 2025 is going to be a very volatile year, and I want to talk today about some factors that take a look at the internals of the market that can give us clues as to why I feel the market may in fact have a fairly good chance of drawing down in 2025. Let's get started. We're going to talk about something called market breadth. And I like to joke that, gee, the market's breadth smells terrible. And it really does right now. Now, I want to explain what breadth is. So let's take a look at a little bit of a chart I put together that kind of walks you through what breadth is and why it's important. So market breadth refers to how many stocks are participating in a move. So if we look at an index like the S&P 500, that's 500 stocks. Actually, it's not 500 stocks. A lot of people don't realize that. It's actually a little bit over 500, but let's call it 500 stocks. Now, if we have a market that's moving up, yet there are only a few key drivers that are the large capitalized stocks that are driving that index up, it kind of fools you. What if it was only 5 stocks doing all the lifting and the other 495 stocks were doing next to nothing? That would be what I call an unhealthy market. So the market may be rising, yet more stocks are falling than rising. And why this happens? Well, you get a number of overrated stocks like Apple, Microsoft, Nvidia, etc. that are doing all the lifting. And again, that says we have an unhealthy patient on our hands, even though they look healthy on the outside. Market breadth indicators can tell us if that's happening. So I'm going to today talk about a few breadth indicators. These are just 2 or 3 of them that I'm going over. I'm not going to cover the full gambit. If you want more information on market indicators, you can read my book, Sideways. It covers all that great stuff. Let's take a look at the advanced decline chart. Now, advanced decline line, for some of you old dogs that have been in the technical analysis world for a while, you'll know what this means. But for those who don't, I'll explain it. An advanced decline line tells us the number of stocks on a given index, in this case, the S&P 500, that have gone up in a given day versus down. If you have a net number of advancing stocks, let's say 50 more stocks went up than down on the entire S&P 500, the line moves up. It's a cumulative line because it's going to track every single day what the net number of advancers versus declines was, and you get a trend of breadth. Obviously, in a market that's going up, if you see the S&P 500 going up and you see the advanced decline line moving up with it, that tells you it's a broad-based advance. But if you see the advanced decline line going down while the S&P 500 goes up, you now know that there's a very narrow leadership happening on the market, and that's a bad thing. So let's take a look. Here's at the left-hand side of the page. This is basically going back through most of the year for 2024. Well, they were kind of moving together, weren't they? The red line, which is the advanced decline line, I'm going to put AD here, and the black line, which is the S&P 500, were moving in sync. And that is mostly the case. But look what happened here. In the spring and summer of 2024, we had the advanced decline line, the red line, moving down. But the S&P 500 kept moving up. And this gave us, I should say, a heads up that the S&P 500 was going to decline. Why? Because markets are unhealthy when it's just a few stocks going up doing all the lifting. You need, in generally speaking terms, a wide audience of stocks moving the market up. When you've just got a few doing the lifting, it's an unhealthy patient. So let's take a look at what's happening right now. The advanced decline line is moving down, and in fact, it took out its last low. S&P, you can see, was going flat for that first period of time when the AD line was climbing. Now the S&P has begun to fall, but it still hasn't taken out. If I delete a couple of lines on the chart here, you can see that the S&P 500 is more or less even with its last low. That, again, is a sign that the advanced decline line is moving at a faster pace to the downside than the S&P 500. So we have an exodus by investors of most stocks on the market. And that's a leading indicator, just like it was back here in the summer where the market had a decline. The next chart we want to look at is the number of net negative days in a given month. Now, I'm speaking to you in December. I have the statistics for November, and this is showing us that in November, there were approximately 12 negative days for the month. Now, if we go way back to 1998, you can see that that's a fairly high number of negative days for this month of November. Well, when else has that happened? Well, 2000. And that led into, as everybody remembers, the 2001 tech crash. In fact, whenever we see spikes of unusual number of falling stocks versus advancing stocks in the market, we tend to see market pullbacks. 2018 led into about a 20% correction on the S&P 500 that December. So remember, in a trading month, you don't actually have 30 days. You have roughly 20 to 22 days. So when we see 12 or 13 days, like we see in 2001, or around 12 negative days, as we've seen November of 24, that's actually a fairly high number. It's actually more than half of the days the market was going down. And yet the S&P 500 went up. So you see more stocks were going down than up, but the S&P 500 looked like it was going up. Unhealthy patient. The next thing I want to look at is just the two indexes that most represent the US market side by side, and that is the S&P 500 that we were just talking about and the more broadly based New York Stock Exchange Index. Now, the New York Stock Exchange average is comprised of about 2,200 stocks, if I'm not mistaken, versus the S&P, as we know, is comprised of approximately 500 stocks. Well, again, the two tend to move together, and it's when they diverge that we have a problem. We are diverging right now. We can see, for example, that the New York Stock Exchange is plummeting and has taken out its last low, whereas the S&P, which is this red line here, is barely moved and is definitely not taken out its last low. So again, we are seeing that the New York Stock Exchange, which is a much broader looking index, is doing worse than the S&P 500. In fact, this line at the bottom here is what's called the comparative relative strength line. All this tells us is, how is the New York Stock Exchange doing against the S&P 500? Well, you can see that for most of the past couple of years, it has been, on a performance basis, underperforming. That means, again, that the more concentrated market of S&P 500, which has a huge weighting in the technology sector and these AI stocks, is outperforming the more broadly based New York Stock Exchange. This doesn't last forever. Final chart to look at breadth today is the New York Stock Exchange new high, new low. Now, what we're looking at here is the number of stocks on a given day that have made new highs and new lows. Now, you guys know that stocks don't always make new highs or new lows, so it's a smaller number. But what we're looking is comparing how many stocks have made new highs. Because if a lot of stocks are making new highs, that's a good thing. It means the market's very strong, and vice versa. What's interesting about this indicator is that it tells us ahead of time that we should be concerned when we start to see new highs versus new lows declining. That means that there's more net new lows than highs. And if the market, meaning the S&P 500, for example, is going up, despite the fact that there's more stocks making new lows, we have a problem. Well, there's a couple of instances through history I could show you, but one of them is the lead into 2008. Do you guys remember what happened in 2008? You may remember the subprime mortgage crisis and the 50% drawdown on the market. Well, look at this. Here's the chart of the new high, new low index, and you can see through 2007, which is down here, right into the market crash, 08-09, the decliners, I should say, the new highs versus new lows index were falling ahead of that market crash. Well, what do we have here? Well, we've had, through 2023, new highs, new lows, lots of stocks making new highs. That makes sense because the market was going up. But look what has been happening lately. Number of new highs versus new lows is plummeting. It's falling quite rapidly, in fact, if you look at this screen. In fact, I'll zoom in. Look at the angle of descent here on the new high, new low indicator. That should be of great interest for those of us who like to see a healthy market. Now, one other thing I want to point out on this chart is that you'll notice I wrote bearish here and bullish there. What I found is sometimes when there's too many new highs, it's an overbought market. And when there's too few new highs, such as after the COVID crash in 2020, you've got an oversold market. Well, this is not the case right now, although we have been moving off of a too many new highs period, as you can see on this chart. The market got a little bit overbought. We started to fall. The problem is it's falling like a brick right now, and that could lead into something like happened in 2008. Now, for more information on my views on the market for 2025, take a look at my video entitled The Year of the Snake. At the end of that video, I give you a 120-year chart on the Dow Jones Industrial Average, and it will show you how we are at this point in time at the top of a very, very long trading range for the Dow Jones Industrial Average that foretells the probability of some sort of a correction in the coming months. Thanks for watching, and we'll see you in the next video. Please don't forget, like and subscribe. It's my Christmas present from you for watching these videos.